Hello again. So now I want to give you my view on what we know about the stock market and returns. So a number of years ago, I ran a little analysis to try to explain one of my students what was going on in the stock market. And I thought at that point that I had to do it in a very intuitive way. So I decided to look at a number of returns for many, many years and see what was out there in terms of just simple returns, winners and losers, just odds of winning and losing. And I started doing daily, monthly, and yearly observations. So I said, I'm going to look at the Dow Jones, which is one of the oldest indices, with over 100 years of daily observations. And I started counting. So, how many positive returns we had and how many negatives. And I found out that there were more winners than losers. So, out of the 30,000 trading days in this 100 plus years, there were 15,000 winners and only 14,000 losers, roughly, right? So this gave me a winner day percentage of 52.18%, right? So okay, so the game is clearly tilted in our favor. And then I looked just daily returns. The daily returns is the equivalent of somebody buying and selling stocks every day. So on average, you will win 52 days and lose 48. When you win, you on average win 0.747. When you lose a little bit more, 0.78. On average, your winning total is 0.027 per day, which annualized gives you about 6.8, 6.9%. If you just literally just buy and sell every single day without even knowing what you're doing. Things are a little bit different. Oops, something happened here. That's going well. When you look at monthly returns, your chances of getting a good month are much higher. They're about 60%. See, 822 monthly returns compared to 569 negative returns. And if instead of buying or selling monthly, you buy and sell yearly, meaning less trading, your chances of winning are even higher. But we do have something very interesting. We get that the positive returns are bigger than the negative returns when we do it by year. And this is over 100 years. And you're free to take a look at this and read some of my commentary here. Then I looked at, well, Dow Jones is an index that has very few companies. Maybe this is not going to work if we use the S&P 500 that says 500. So I looked at the S&P 500, which has less information, only from 1950, and boom, the same pattern. More winter days, more winter months, more winter years. And what happens is that even if you don't know what you're doing, the odds are on your favor, 53%, 60%, 68%. And then I went to look at, well, let's see if this happens elsewhere. I look at Hang Seng, which is Korea, Hong Kong, the FTSE in London, the stock market in Germany, Japan, Brazil, Mexico, and the world. And if you look again at the count of positive returns, it's always bigger, right? So these are daily observations. There's always more winners than losers. So if you're going to hold companies, well, and you know these numbers, you decide what to do. Winners, losers, averages, you make your decision.